Today, we're diving deep into two critical financial risks that can significantly impact your retirement savings: sequence of returns risk and sequence of inflation risk. You may have heard about sequence of returns risk before, but sequence of inflation risk is just starting to gain more attention. So let's break these down, understand their differences, and most importantly, how to mitigate them in three scenarios: pre-retirement, portfolio management, and post-retirement. If you find topics like this helpful, take a moment to subscribe for future content. Your support is very much appreciated. Let's start with an overview of these two critical sequence risks that can significantly impact your retirement savings. Sequence of returns risk is probably the more familiar one. I'll provide a link in the description to another video where I cover this in detail. It refers to the order in which investment returns occur during retirement. Early negative returns can really deplete your savings, compared to if you had positive returns first. To visualize this, let's look at an example from Beacon Financial Strategies. They looked at two retirees, one who retired in 1991 just before a strong bull market, and another who retired in 2007 right before the global financial crisis. Both started with $1 million in a 60-40 portfolio, and used the 4% withdrawal rule. They assumed a fixed 3.5% inflation rate for both scenarios. After just 10 years, there was a $1.5 million difference between their portfolio balances. This difference illustrates the impact of sequence of returns risk. Early negative returns, combined with regular withdrawals, can drastically deplete your savings, limiting potential future growth. Now, that example assumed a fixed inflation rate of 3.5% to isolate the effect of market returns. But what happens when we factor in real inflation? I ran some numbers through FI Calc using actual historical inflation figures. The average inflation for the two 10-year periods was 2.8% starting in 1991 and 2.4% starting in 2007. The difference in portfolio balances was closer to $1.1 million. This illustrates why using fixed inflation can be misleading, and shows the real impact of inflation. Interestingly, if the 2007 retiree had deferred retirement by just 2 years, and retired in 2009 instead, the difference in portfolio balance would have been $420,000, in favor of the 2009 retiree. This shows the significant impact of timing your retirement, in relation to market cycles. Of course, the 2007 retiree couldn't have foreseen the global financial crisis looming in 2008. Now, let's look at a different decade: the early 1970s. Two of the worst years to retire were 1972 and 1973. In both cases, the portfolio would have lost 60% of its value in just 10 years. That's not a great position to be in, just 10 years into your retirement. Following these cohorts out to 20 years, we see the 1972 and 1973 group remain some of the bottom performers. The other factor besides market returns impacting these two cohorts is, unsurprisingly, inflation. This brings us to the lesser-known but equally important sequence of inflation risk. While many people focus on market returns, inflation can be just as damaging to your retirement plans. Sequence of inflation risk has been discussed in financial circles for over a decade, with discussions on the Bogleheads Forum dating back to 2011. It has gained more prominence recently, thanks to articles in publications like Morningstar and blogs like Kitces.com. It refers to the erosion of your purchasing power due to inflation, especially when high inflation occurs early in your retirement. As prices rise, you'll need to withdraw more money to maintain your standard of living, depleting your savings faster. The tricky thing about inflation is that it's cumulative and compounds over time. That's why it's so crucial to factor in an inflation premium when calculating how much you'll need in retirement. To illustrate this, let's look at an example using data from 1973, a period of notably high inflation. I used a 100% equity portfolio invested in the S&P 500 with a fixed average return of 12.1% to isolate the impact of inflation. Comparing the actual inflation sequence to a reversed sequence over a 30-year retirement, the results were striking. The actual inflation sequence resulted in a final portfolio balance that was 63% lower than the reversed inflation sequence. We're talking about a $1.8 million difference. The actual sequence ended with $1 million, while the reversed sequence had $2.8 million. This stark outcome highlights the severe impact of sequence of inflation risk. What if we factored in real S&P 500 returns over this period? Now, we will see sequence of inflation risk working in tandem with sequence of returns risk. The portfolio value dropped significantly early in retirement. It only managed to recover due to an unusually strong bull market over 5 years in the late 1990s, with cumulative gains of 143% over the 5-year period. This is an anomaly and not something you should count on in your own planning. If we remove the exuberance of the tech bubble and use the fixed average returns of 12.1% for 1995 to 1999, we find a drastically different outcome. The final portfolio balance in this case is 50% less than that based on historical data. That includes the tech bubble. Here's a question. How does this compare with the scenario where the sequence of returns and sequence of inflation were both reversed for the period starting 1973? The difference is a staggering $1.5 million. These scenarios illustrate the impact of sequence of inflation risk when it co-occurs with sequence of returns risk. This is the worst-case scenario, characterized by negative returns with high inflation. On the other extreme is the best-case scenario, with high returns and low inflation. Both sequence of returns and sequence of inflation risks share many similarities, such as the need to increase the withdrawal rate and the cumulative, reverse compounding impacts. Negative returns or high inflation early in retirement can lead to higher withdrawal rates, either due to lower portfolio values or reduced purchasing power. However, there are 3 key differences. First, the focus of these risks is different. Sequence of returns risk affects the absolute value of your investment portfolio. Early negative returns reduce portfolio value, leading to higher withdrawal rates and less potential for future growth. On the other hand, sequence of inflation risk doesn't reduce nominal portfolio value, but increases the amount you need to withdraw to maintain the same standard of living. Second, markets historically recover over time to reach new highs, so the impact of poor market returns is transient. However, inflation continuously erodes purchasing power and tends to have a permanent effect. Price increases rarely reverse, and the erosion of purchasing power compounds over time, meaning that a dollar today buys less and less in the future. Third, sequence of returns risk is often addressed with lower risk, lower volatility assets like cash and bonds. These provide stability when markets are down, to protect against selling growth assets. In contrast, to mitigate sequence of inflation risk, higher growth assets, specifically equities, are more effective. Equities are likely to outperform bonds, including inflation-protected bonds like TIPS or inflation-linked gilts, and are better at preserving purchasing power in the face of rising inflation. This creates a conundrum. You need stability to weather market downturns, but also growth to combat inflation over a potentially 30-plus year retirement. In my opinion, the simplified bucket strategy, which I discuss in another video, provides an effective framework to balance the competing goals of mitigating sequence of returns risk and sequence of inflation risk. This straightforward 6-year, 2-bucket strategy is designed to offer peace of mind without the unnecessary complexity of the 3-bucket strategy. It creates a 6-year short-term buffer to mitigate sequence of returns risk. At the same time, the strategy allocates around 75% of your portfolio to equities. This focus on equities helps your money grow over time and combat sequence of inflation risk, especially considering rising life expectancies. So, what does all this mean for your retirement plan? Let's look at mitigation strategies for sequence of inflation risk in 3 parts: pre-retirement, portfolio allocation, and post-retirement. I won't go into depth on these topics here, but let me know in the comments if there are any areas you'd like me to cover in more detail. Starting with pre-retirement strategies, there are 3 mitigation options in pre-retirement. First, consider a phased retirement, if this is an option with your employer, by gradually reducing your work hours while continuing to save for retirement. This can provide a good balance between full employment and full retirement, allowing you to ease into retirement, while monitoring the market and adjusting your saving strategy. In the UK, be careful not to trigger the Money Purchase Annual Allowance or MPAA by taking taxable withdrawals from your pension. This will reduce your pension annual allowance from £60,000 to £10,000. Second, plan for higher inflation. When using retirement cash flow planning tools like Voyant and Timeline Planner, Factor in higher inflation rates, say 3% to 4%, and enable the Monte Carlo simulation feature to stress test your portfolio under more adverse inflationary conditions. Be aware that this could leave too much money on the table, so consider adopting dynamic withdrawal strategies to maximize the enjoyment of your retirement savings. Third, start with a lower initial withdrawal rate. This might mean working longer to build a bigger nest egg, or adjusting your lifestyle expectations. Understanding your discretionary expenses is crucial, as it will allow you to tighten the purse strings and reduce the withdrawal rate when necessary. Next, on to portfolio allocation considerations. First, inflation-linked annuities. In the current high-interest rate environment, annuities have regained popularity among retirees, who prioritize a guaranteed income stream. There are many options to consider, such as fixed-term versus lifetime annuities, and level versus escalating versus inflation-linked payments. As with most financial products, greater certainty comes at a higher cost. With escalating and inflation-linked lifetime annuities, it takes about 20 to 25 years to recoup your costs, known as the annuity payback period. A good middle ground is a fixed-term escalating or inflation-linked annuity for the first 10 to 15 years of your retirement, providing protection against both sequence risks. Second, inflation-linked bonds like index-linked gilts or US TIPS can provide a hedge against inflation, as their value increases with inflation. However, a substantial allocation to equities is essential for growth over a long retirement period, especially with rising life expectancies. Which nicely leads to the third portfolio consideration, equities. While bonds offer some protection, historically, stocks have been the best long-term inflation hedge. Equities are also your best hedge against portfolio longevity risk. Aim for a globally diversified, balanced portfolio with a healthy allocation to equities, typically 60% or more, depending on your risk tolerance. Finally, let's briefly look at post-retirement strategies. First, the same complementary strategies effective against sequence of returns risk are also relevant for mitigating sequence of inflation risk. These strategies include discretionary spending cuts and downsizing to reduce expenses, and rental properties, side hustles and part-time work to generate additional income. Second, consider inflation heuristic rules to manage inflation impacts on retirement portfolios. The first is the inflation waiver rule, which suggests foregoing inflation adjustments for the following year, if the portfolio's value declines in the current year. Guyton proposed this rule in his original 2004 paper, and it is widely adopted by Morningstar, Vanguard, and T. Rowe Price. However, it can be too rigid, potentially leading to unnecessary lifestyle reductions even with minor portfolio declines. The second is the inflation haircut rule, which I think of as a lighter version of the inflation waiver rule. Instead of entirely skipping the inflation adjustment, it reduces the adjustment by 1% for a given year, regardless of portfolio performance. Research by David Blanchett shows that this approach can result in a 0.5% higher initial withdrawal rate, while maintaining a 90% success rate with a 50-50 portfolio. Unlike the inflation waiver rule, this method better aligns with actual inflation, albeit with a slight reduction, which helps to preserve purchasing power over time. Third, dynamic withdrawal strategies can help manage both sequence of returns and sequence of inflation risks. These strategies adjust your withdrawal rate based on market performance, helping to sustain your portfolio throughout retirement. These include the Vanguard Dynamic Spending Rule, Guyton-Klinger Guardrails, Kitz's Ratcheting Rule, Bengen Floor Ceiling, and Cape-Based Withdrawal. I have covered a number of these in other videos, and will include links in the description for anyone interested in exploring further. For instance, the Guyton-Klinger Guardrails strategy involves adjusting withdrawals within specified limits based on portfolio performance. If your portfolio does well, you can increase your withdrawals, but if it underperforms, you reduce them. This helps to preserve your savings and manage both risks effectively, and strikes a good balance between portfolio longevity and enjoyment of your hard-earned retirement savings. Understanding and managing sequence of returns and sequence of inflation risks are crucial for a secure retirement. Let me know in the comments if you have any questions. I'd be happy to clarify or go into more detail on any aspect. If you are still here, thank you for your time, and I hope you found this helpful. Don't forget to like, share, and subscribe for more content. Thanks again for watching, and I'll see you in the next one.